Hi, Kevin. How are you?
I'm well. How are you? Nice to
Good,
see you
good,
again.
good,
Well, nice
good.
to hear you again.
Good to talk to you today. I'm excited about today's conversation.
So am I. So am I. Yeah, this should be fun. All the time I thought it was actually a 2 hour session. And just today I was like, ooh, it's 1 hour. So I'm like, all right.
Yeah,
So I'm
just
gonna
an
need to
hour.
fly through this.
Yeah. Yes, yes, yes.
Okay.
I
Okay.
bet you could talk about this topic for 2 hours, though.
Yeah, I can. And you said it's okay to showcase a little bit of deal flow as well.
Oh, absolutely.
Fantastic.
Yep.
Hello.
Hey, T.
Hi, Talisha. How are
Hello.
you?
I'm all right. How are you?
I'm good. I'm good.
I feel like I talk to you every day.
Hilarious. My bestie.
I do. I feel like I'm like, did I
Watch
just
out,
talk to you?
Kevin. Watch out. This is my bestie. Watch out.
We do talk a lot. I'm just saying. I'm like, I just saw
Yeah.
you. I just spoke to you.
Mm.
I love it.
All right. Oh, we recording. Let me behave.
We are. Let's see. A couple of people coming in. Good evening. Good evening.
Good evening, everybody.
Hope my light is okay.
It is.
Okay, good, good, good. I always get nervous when I'm not in my space.
You're traveling right now?
I am.
Yeah. I from STL. All right. I from TNT.
Mm. What is this?
Hi, Kimberly. Hi, Miss Patrice.
And the folks.
Give it a couple of minutes.
Sure.
And we will get started because we got a lot to talk about tonight. This is a very important topic. I am super excited about this topic, and I'll just kind of tee it up while we're waiting. So, next week we're doing a deep dive into due diligence. And it made sense that before we talk about due diligence again and kind of teach the community all the things they need to be looking for when looking at deal flow, the thing that I always find that people are the most confused by is the valuation, right? It's like you almost want it to be high because that kind of makes you think the company has right a good chance of being successful, right? Oh, if they're valuated at a high number, they must be good or must be doing good for themselves. But then from an investor standpoint, really, you kind of want it to be a little lower so that when it increases, then you benefit also, at that point. So I really was like, okay, how do we break down valuations and really learn the benefits of it, right? What it means to us as investors and how to utilize it when we're doing due diligence, but then also when we're just looking at deal flow. And Kevin was the perfect person to come and talk to us about this. And so I want to introduce you all to Mr. Kevin Valley. Kevin, I'm going to let you tell the community members all about you. Kevin is a member of the 10K Project as well. And we are so happy to have him. You guys know I always just love when we get members who are specialists at something and they take time out of their busy, busy schedule to come talk to us and teach us. And so, Kevin, thank you so much. We know the most important thing you can give to someone is your time. And so we appreciate you giving yours to us this evening. I'm going to turn it over to you so that we can get this party started and learn about valuations and why they're important and how the heck do people come up with what they are. That's
Excellent.
the magic question for tonight.
Excellent questions. Okay, so what I want to do, I just want to get this deck up. So I just want to get through this awkward part where I'm trying to share my screen and try to toggle between this screen and that screen. So I'm just trying to get that up. But good evening, everybody. It is a pleasure to be on here. I've quickly become a huge fan of the 10K platform. I look at most of the pictures. I just looked at the the gentleman session just last night.
Nice.
You know, some really, really exciting stuff. And I mean, I was really sad to hear that story of the gentleman with the AI business about his experience when he went to San Francisco. You know, so it really shows you the importance of platforms and communities like this in supporting people that look like us. So if you guys are listening to me and thinking, oh, he has that little twang, where is he from? Where is he from? Right here in the beautiful island of Trinidad, and I am representing the Caribbean. I am so happy to be here. And I am waiting for my computer to load this up. Here we go. Okay. All right. And in the meanwhile, I guess you guys could jump in the chat and let me know where you're from. I see somebody's from SDL, that's St. Louis. I see somebody from LA. Hi, Patrice. Hi, Kimberly. Okay, come on. Okay. Fantastic. All right. So let me just talk here. Okay, are you guys seeing this?
Yes, sir.
All right, fantastic. Okay, so by means of introduction, I am a consultant. I specialize in working with companies who are looking to raise capital, also looking to demonstrate business value. I have, I'll say, over 15 years of experience doing debt and equity financing, so analyzing companies for debt and equity investment, everything from stock analysis, capital markets, corporate banking, and the like. And about 4 years ago, I became a chartered business valuator after a very rigorous program. And I started my own consultancy practice where I was valuing companies who are looking for investment. I also am a minority partner in a private equity firm based here in Trinidad, and I do their valuation due diligence for both investment as well as financial reporting to auditors. So today, we're going to try to fly through as quick as possible. I apologize. I assumed the session was 2 hours. I just learned it was 1 hour, so I'm going to speed. All right, but you guys could jump in anytime with questions in the chat. I'll be looking at the chat. And yeah, let's keep it going. All right, so we're going to do the fundamentals of valuing early stage businesses because from what I gather, most of the companies that come on this platform and pitch to you guys seeking funding are usually earlier stage companies, or if not, companies that are existing companies that are looking to fund new projects. So because they want to get into a new line of business or they want to expand into new territories, we still look at that as a similar level of risk as a new entity. Okay? All right. I'm going to highlight some of the outrageous claims that early stage business owners make and that you also need to be wary of, especially when doing your due diligence, because what happens is that founders are going to come on a platform like this. They're going to present the world. It's going to look nice and rosy, but we want to make sure that we are evaluating investment opportunities with a sober head. Okay. And I'm going to do a walkthrough of a sample company, an actual valuation I did, I'll say back in 2022, just to show you the mechanics of valuation. I'm going to try my utmost best not to make it too boring, but I'm going to show you copies of my Excel sheet and show you what that process was like. All right. And then I'm also happy to show you a couple of current investment opportunities that I have available as I work with clients who are seeking funding from lovely folks like you guys. Okay, so we tend to use early stage as a catch-all term, right? But there are actually different levels to an early stage, right? So there's the seed stage where the company is looking for money to get started, right? So there's no concept proven yet. It's that idea stage, right? There's the startup stage where, okay, they've proven some level of concept. They've gotten some little bit of traction. Now they need money to really hit the ground running and really generate attractive revenues or revenues that show real promise. And then you have the growth stage where, okay, they have if they maybe they've made a big splash, things are going well for them, but they really need to ramp it up to the next level. All right, so companies that are in the seed stage, they're typically approaching investors for three particular reasons. One, to fund the further development of their idea. Two, to establish a business model and a financial plan. And three, to build a presentation to raise additional funding. So again, this is very, very early. It's smaller checks, could be as low as a couple $1,000, maybe as high as 250,000 in most cases. All right. At this stage, the risk of the investor losing the investment is extremely high due to the large degree of uncertainty. Now let's talk about startup stage companies. These companies are a little bit further along the development spectrum where you may have a prototype that's been developed, it's being tested. You see that there's a management team beginning to form. Consideration is being given to how the product or how the technology is going to be produced and marketed. And there might be a hint of a commercialization strategy. The company may have prepared a business plan with some projected cash flows for us investors to look at and dissect and conduct our due diligence and see, okay, does this make sense? Is this credible? Is this achievable? So these startup businesses, they seldom have significant revenue because, like I said, they're in the process of commercializing their technology or establishing a customer base and a market presence. So the main challenge faced by founders in this stage is conserving their scarce cash resources. So they're bootstrapping a lot. They're very self-funded while ensuring that the company is actively developing its product and market presence. So if you think about companies that might have graduated from an accelerator like Techstars, so they get a lot of coaching and whatnot there, but the actual funding they get there could be somewhat small. How are we doing so far, guys? I just want to make sure everybody's with me.
Yes,
Any
sir.
questions so far?
Yeah.
Chat? Okay.
The chat is good. We're good.
All right. Once the chat is good, I'm good. All right. So let's talk about the growth stage now. So companies in the growth stage, these guys have typically assembled a management team. They're beginning to generate revenue, might be from the sale of their product or might be from the licensing of their product if what they've created has a significant intellectual property component in it. All right. So this is the type of companies that are favored especially by venture capital investors, because the venture capital investors seek high return, just like we all do. So although the risk associated with a company in the growth stage is significantly lower than in the earlier stages due to the existence of traction or what have you, the company still faces a level of uncertainty. There's still a level of risk around its ability to grow and scale its business. So yeah, these companies are most frequently encountered by evaluators and investors where future earnings are based on some form of technology or licensing. Okay. All right, so I want to talk a little bit about some characteristics of early stage companies, and then I'm going to get into the common claims or the common mistakes they make when pitching to investors. All right, so firstly, characteristics of early stage businesses. Now, in many cases, one or more of the products is not yet fully developed, although they may have resolved a lot of the major technological uncertainties. Now, the business may not have begun to generate revenues, but commercialization might be imminent and revenues could be anticipated in the next 12 months. So they have that line of sight where they could credibly forecast revenue generation. The company may, of course, being an early stage company, the company lacks a meaningful financial track record. Management may be entrepreneurially focused, but lacks that financial sophistication and experience. The company will have a few hard assets, other than they develop technology or the intellectual property. And the complete management team is not yet in place, and the sales and the marketing senior executives are not yet on board. So it's still a group of folks just, you know, trying to do something, trying to do a thing, as we say here. The marketing plan or the strategy is incomplete and has not yet been completely implemented. And more often than not, they may not have strategic partnerships in place as yet. So again, things are very early, it's very uncertain. So we really have to rely heavily on the strength of the founder's idea, right? And I actually have a little framework called the idea check that I will speak about in a little bit. All right. At this point, I want to talk about some of the common mistakes founders make when pitching, or the common claims that they make when pitching. Does anybody have an idea? Anybody have an idea of some of these claims? Let me see in the chat. No?
One common claim is oftentimes they say they have no competitors.
Correct. That's one. That's one. Any others? Listen, chat, don't be shy, you know. I'm the one on camera, you know, guys. You guys, you guys just have to type.
Don't be shy, guys.
I know a lot of people refer to just because they've got an investment, they use that, they conflate that with revenue. And those
Oh my
are
God.
not the same things.
You know, that one is not even on my list, but I think that should be there. Like,
Yes.
people fundraise, I'm like, oh, I'm so successful.
It's like, that's not revenue.
Ms. Patrice says one of their claims is that they say that other companies or VCs are interested or waiting in the wings. So they say that, I guess, to entice you to say that if you need to get in now because the big boys are coming. And then Kevin said underestimating funding required to launch.
That's a good one, Kevin. That's a very good one. And Patrice, wow. Yeah, no, well, that's, I mean, I would say that's worse than a mistake. That's like that's
yeah, that's just a bold-faced lie if it's not true, right? I mean, that's deception, Ms. Patrice.
Patrice also says
just because you get an email and you send an email doesn't mean that you have waiting in wings investors. So that may be the thing, just because you're putting yourself out there. And I think that's needed, but to make the claim that somebody is interested when you just really are in the truly getting to know stage is kind of low putting.
100%. I see Patrice wrote confusing revenue with profit. Yes, you know, so that I would say yes, that is a big common error. And I also say that I would say that revenue proves concept because it proves that people are willing to pay for whatever it is that you came up with. But I think profit proves your business. It proves your business model because it proves that you're able to operate the business in a way that is profitable and it makes sense for shareholders. But thank you for that, Patrice. That is a really good one. Okay, so claim number one that we see all of the time. This is a $100 billion market, and we only need to capture 1%. Right? The market for the product, the service, or the technology is extremely large, and the company only capturing a small market share will be able to realize sales in the millions of dollars in the first years of commercialization of the technology. Right? So obviously, there's a lot more needs to happen. A lot needs to happen for you to get at 1%. Right? So we need to see a proper go-to-market strategy and proper team on board before we see that. Yeah, yes, Jessica. I strongly advise founders not to go with that without having some credible backing and some research. I don't say that you need to capture a percentage. Just say, okay, these are the people I'm targeting. These are the prices I'm going to charge for this service. This is what I see them paying for similar products and services in the market. So I think with advertising strategy of X, we could get these amount of people to buy our product, and this is the revenues we expect to achieve. That is a more investor-friendly way of putting it across. All right, so Tawana hit this bang on the head, where they say that there are no true competitors in the marketplace, and the company will be able to come to obtain significant market share shortly after its introduction to the marketplace, with minimal or no marketing and advertising costs to be incurred. And more often than not, there's no independent study or anything to back this claim. Just pure guts and gumption. And a claim that which I think is cousin to the prior two claims are these unrealistic projections, right? And I do encourage founders to prepare projections all the time, right? You always want to have projections. But first you need to have your business plan, right? So from your business plan, then you're able to develop assumptions and forecasts that will guide your financial projections. And then once you have your business plan and your financial projections, then you're ready to create a pitch deck to go to investors. Far too many times, folks do this in the wrong order, and they just create a pitch deck, put some numbers on it that they think they're going to achieve. And when sophisticated investors ask the hard questions, it's, let me check and get back to you. And those sorts of situations. So we want to avoid situations like that. Founders want to avoid situations like that as much as possible, and investors want to be wary of this. All right, so don't need to spend too much time there. Everybody gets that point. Okay, so now let's talk about valuation of early stage companies. Many times, and this is what the founders don't want, but many times early stage companies, especially pre-revenue companies, are valued using an asset approach. And I'll explain what is an asset approach very shortly. The asset approach consists of restating all of the assets, so be it the tangible assets, so the fixtures, the fittings, the identifiable intangible assets. So you're thinking your trademarks, your patents, goodwill, and all of that at their current market value. The value of the assets, which in many cases is the startup company's technology, can be determined using the cost to duplicate approach. So basically, what's the cost to recreate this tech? What's the cost to rebuild this product as it is right now? The income approach or the market approach. So what is the theory behind the asset approach or the cost to duplicate approach in this instance is based on the notion that a smart investor wouldn't pay more for a startup than what it would cost to duplicate it. So the cost to duplicate a high-tech startup or any particular startup might include things like the cost spent on research and development, the cost of patents, the cost of developing, and the cost of developing prototypes. Now, the big problem with this, especially when I put my hat on it, where I'm advising founders, the most significant problem with this approach is that it doesn't reflect the company's cash flow generating potential in the future. It's basically just valuing the company as if, okay, well, I'm just going to build that thing too, not taking into account, okay, well, how the founder expects to make millions of dollars using this product technology going forward. And it also doesn't capture any brand or any of the intangible value that the company, even though it might be a startup, might have developed. So that being said, it can provide a useful metric against which other valuation methods are contemplated. So what I would look at the asset approach as is the floor for what the valuation of a company should be. Like that should be the lowest point. So, and the one caveat I'll say that is unless you're investing in a company which is like an investment holding company where your holding company and all you have is assets, right? So all your holding company, and then I have this business, that business. Then you'll value those assets separately, and you'll sum it up and be, well, that will be the value of the company. That will where an asset approach will make sense. Okay. So we talk about value. What is the value of a business investment? Really quickly, anybody in the chat, I love to engage the chat. Really quickly, anybody in the chat, how would you define the value of a business investment? Kevin, yes, earnings generations, yes. Earnings generations, according to Kevin Brooks. Anybody else?
I guess this would be a value question to whom? Is it to the shareholders or to the customer? That's the question I have before answering who
Yes,
has the value.
to the shareholders, to the investors.
Is that this is sustainable, has some availability of sustainability and for growth? Those are the kind of questions I would have to whatever the value, even if it's a small percentile. Is it replicatable, sustainable, and can be replicated to a point of growth?
Okay. Yes. So what I will do, I'm going to give you guys, and Kevin, I see your question in the chat. I will get to it in a second. I'm going to give you guys the academic definition of the fair market value of a company. Okay. And then I'm going to give you my simplified definition of value. So for the purposes of company valuation, fair market value is defined as the highest price expressed in terms of cash equivalents at which property would change hands between a hypothetical willing and able buyer and a hypothetical willing and able seller, where they're both acting at arm's length in an open and unrestricted market where neither is under compulsion to buy or sell and both have reasonable knowledge of the relevant facts. Right? So what I would say now, I would say value, especially of a business or financial asset, is the returns received from that asset over time. Right? The returns received over time. And I say over time because time has value. If we receive $5 million, if we exit at $5 million today versus exiting at $5 million 5 years from now, it is way more valuable to exit at $5 million today because of things like inflation and opportunity costs. What can we could take that same $5 million and invest it in something and turn it into $50 million. Right? So that's important. So that especially when you look at the Silicon Valley marketplace and you look at companies are being acquired for hundreds of millions of dollars or whatnot, and then a startup company in a similar vertical or similar industry will want to be valued by that same metric. You have to factor in, okay, what is the likelihood that my company is going to experience a successful exit like that? Right. Another important thing to look at valuation, especially when you're talking about bigger companies and what have you, is that there's a value that you have to ascribe to synergies. So there's the value that let's say McDonald's wants to purchase Burger King. The value of buying Burger King for McDonald's will be way more than if I wanted to buy Burger King, because I don't already have a fast food business where I'm creating burgers. I don't have existing technology that will benefit from whatever technology the Burger King has. Okay, so we mentioned the highest priced obtainable. So in that case, if you have Burger King and then you have Wendy's and then you have Arby's or whoever else in the market to buy, then all right, that is the market of buyers right there. These people like us here on the call today, we're out of that market because, well, we're not going to pay that price. It's not worth that to us. So there's some things to bear in mind. Okay, so I mentioned before that we have three approaches to valuation. That is the asset approach, the income approach, and then the market approach. Companies in the startup stage, particularly those who are generating revenue, they're often valued using some form of income approach. More often than not, this is the discounted cash flow approach. Okay, once a company has projections and you expect that a company's a going concern, it's going to be around for a long period of time, we use the discounted cash flow approach. Okay, I'm going to take a pause for a second to look at Kevin's question. What would be a practical example of a revenue projection you're familiar with in your experience? For example, our projection is a 95% probability that revenue will be in the range of a low to a high for each of these years over the first 5 years. Okay, so if I'm to understand your question correctly, Kevin, what I would say, especially in a circumstance where I'm valuing an early stage business with aggressive revenue projections, aggressive revenue and profit projections even, what on a conservative approach that I take would be that I would add, just like what you said, I would add likelihoods of achieving those projections into my discounted cash flow model, right? Especially if those projections seem unfounded and it's completely different to what I've seen them achieve in the past year or past couple of years, then yes, I will apply percentages for likelihoods. Please let me know if I answer your question. Okay, so with the discounted cash flow, is that management is generally quite okay. Great, happy that you're good, Kevin. Management is generally quite optimistic about the company's future prospects, and it is not at all unusual for them to have a 5 to 10 year future cash flow projection accompanied by a preliminary discounted cash flow valuation analysis to present to the investor. And investors and evaluators are trained to exercise caution, or they should exercise caution, when considering the use of founders' projections due to the uncertainties associated with the future cash flows, as well as the challenges in selecting a discount rate which appropriately captures the risk facing the startup company. So at this juncture, I want to ensure you all remember this point for as long as you plan to invest in businesses. And this is the key that I use when I'm thinking about value of a business. Its valuation is based on two main things: risk and growth. That's it. Valuation is based on risk and growth. So this is what many people think risk is. Risk is you're jumping over a bridge and you may fall and die or severely injure yourself. Or in an investment sense, they think risk is all of your money going up in flames. But what risk really is, in an investment sense, is that uncertainty or that variance of the expected future cash flows, right? The unpredictability of your cash flows. That is what risk is. That's what financial risk is. So if that's risk, then what's growth? Growth refers to the growth of the company's expected future performance or cash flows. And for this reason, I always advise founders that in every business decision they make, whether it's in negotiating with a customer or a strategic business partner, deciding on suppliers, product development, admin, ask yourselves two questions. Will this grow my expected future cash flows? Will this add or reduce the risk in my business? Because investors want to predict predictable growth as much as possible, as predictability reduces perceived risk. If you know that this asset is going to give you a steady stream of returns, you could sleep at night. If you think that your money could go here one day, there one day, up the next day, and down and never come back up, that's a different level of risk. So that's that volatility there. Okay, how we doing? Okay, just at the halfway mark. I'm proud. All right, so at this time, I just want to pause for any questions that we may have.
Nope, sounds like we're all good.
Right. Okay. All right, let's talk about some of the risk affecting the future cash flows of early stage businesses. Potential loss of uniqueness, excessive cost of development. So if developing your product or service just happens to be costing more and more, there are retweaks, and all of that. That's a risk, especially if for founders that are bootstrapping. The risk that the market changes due to technological advancement. So artificial intelligence is one. New government regulations that may render your product, that may make you have to shelve your product or really redevelop your product or relook at how you present your product. Loss of key employees, or even in some cases, death of key employees. Arrival of new competitors. Insufficient resources to market or develop the products and services. So lack of capital. Unproven technology or product leading to customers' reluctance to adopt your product on a wide scale. So you thought you're gonna hit that 1% of the $10 billion market, and then it was a bust. Okay, so I mentioned to you guys that I had a little framework called the idea check for entrepreneurs to screen their ideas and determine if it's an idea that is scalable or investable. And I'm going to run through it quickly. So it's based on the word idea. The I is for innovation. So the question is, does the business idea offer a new or unique solution to an existing problem or need? Or is there a clear differentiator that sets the idea apart from existing solutions in the market? What about intellectual property? Can the idea be protected by registered IP such as trademarks, copyrights, patents, or internally generated IP, such as trade secrets, which allow the founder to provide their product or service in a manner that is better, faster, or cheaper than the competition or any incumbents in the market right now. So innovation is definitely a critical factor in attracting investors, as we're often looking for new and disruptive ideas to be a part of. All right, so the D is for demand. Based on the customer pain points the founder wants to address, or the new solution they are considering bringing to market, have they proven significant demand for their product or service? Now, this could be determined by analyzing market trends, customer needs, and the competitive landscape. A strong demand for the idea increases its investable value proposition. Okay, so the E is for execution. Can the idea be executed effectively? Does the founder has the necessary skills, the resources, the team, and infrastructure to successfully bring the idea to the market? As investors, you're looking for businesses or projects that have a clear and achievable plan for execution. Now let's talk about access. How big is the target market? Is it accessible and reachable? Of course, investors are interested in businesses that can tap into a large and growing market. Now, I always want to make a little bit of a distinction between demand and access, or demand and addressable market, because they're related, but they are two distinct concepts, where demand refers to the total quantity of a product or service that customers are willing and able to purchase at a given price at a specific point in time in a particular market. And it's a measure of the market's appetite for a product or service and reflects the underlying economic factors that influence consumer behavior, such as price, availability, and consumer preferences. And on the other hand, The addressable market refers to the portion of the total market demand that a particular company or product can potentially serve. It's the market that the company or product can realistically target and capture based on its unique value proposition, market positioning, and competitive advantages. All right. We are ready to look at a DCF model. We are ready to do a discounted cash flow valuation. All right. Can everybody see this clearly? Oh, is it showing up? Is it showing up clearly here?
It looks good.
All right, great. Okay, so we start with the assumptions. All right, good. We start with the assumptions. This is a valuation of a company based in Trinidad. So I use the tax rate in Trinidad as at that time, with the corporate tax rate that that company faces. The discount rate, I will show you how the discount rate or the required rate of return was calculated in another slide. The perpetual growth rate, so that 2.75%. The perpetual growth rate is what we expect the company's earnings and cash flows to grow at, what rate we expect the company's earnings and cash flows to grow at in the period beyond that last forecast period, that last forecast year. So that will be in that exit/terminal value. So again, we hope that these businesses are going to be around indefinitely. And of course, we'll also model for the risk of, okay, maybe this business might close down in 5 years. But all remaining the same, all remaining unchanged. We expect that these businesses will be around indefinitely. So we have to forecast what we expect the rates of growth to be in that period beyond the explicit forecast period. So based on the projections that the company give us and our due diligence on same, we're going to come up with revenue projections, and we're going to come up with EBITDA or operating profit projections. So if anybody's wondering what is EBITDA, and if I'm speaking a foreign language, EBITDA is an acronym for earnings before interest, tax, depreciation, and amortization. All right. So we're going to look at what is the earnings before interest and tax. We're gonna, if we have any adjustments to make for any non-recurrent items. So for instance, if the company made a special purchase or incurred a special expense that year, but it's not part of their normal operations, then we'll back that out. Now, this particular company had some tax losses, that can be used to offset future taxable income in the future. So that is why you see these figures over here in red. All right, so then we get to net operating profit after tax. And then we add back the depreciation and amortization, because depreciation and amortization is a non-cash expense. It's how we account for the wear and tear of our physical assets, but it's not something that comes out of our pocket, right? So of course we need to add that back if you're trying to recognize, hey, what cash is coming in and out of our pocket. Now, capex. Kevin says, let me get my glasses on that one. Yeah, I had to get eye surgery to be able to do this. All right, so capex, that's capital expenditures. That is the purchase of physical assets. So purchase of property, plant, equipment, office equipment, furniture and fittings for the company. So of course, those purchases, those are cash out. So you're gonna have to subtract that when determining what's the free cash flow for the company. And then we're going to look at changes in net working capital. So this refers to dealings with your debtors and creditors, right? The people who owe you and the people who you owe. So if your business that you're selling products on credit, you give people 30 days before they have to pay you. While you may recognize the sale now, you haven't booked the cash yet. right? So that because of that timing mismatch, that creates an accounts receivable and a higher accounts receivable. We treat that as a cash outflow because money hasn't come into your account yet, although in the income statement, or we recognize revenue for it, so we just have to back that out. And on conversely, if we owe money to a supplier and the supplier gives us, hey, you get 60 days before you have to pay for that. That's great because that's like free financing, right? So that will be treated as an inflow. I could get more technical than that, but yeah, I'm just trying to keep this interesting. Okay, so from there, from there we determine what is the free cash flow to the firm, to all of the owners of the firm, so that we the debt holders as well as the equity holders. I spoke a little bit about the perpetual growth rates and the determination of the terminal value. Now, you see, I have exit/terminal value. This accounts for the possibility that, hey, maybe they may sell their business sometime in the future. Or the perpetual growth rate says, okay, well, this business is just going to stay operating as is for the foreseeable future, and beyond year 5, it's going to grow at a rate of 2.75%. And the reason we usually use a rate of, say, 2.5 to 3%, because we look at what rates does the economy grow at, so we think about that steady state sort of thing, just to be conservative as well. All right, so we'll speak about discount factors and discount rates and required return on capital in the next slide. But this goes back to time value of money that we spoke about. So $33 million sometime in the future is worth less than receiving $33 million now. So you see the discount rate, the discount factor is lower there. All right, so when we do that math, we determine what's the value of business operations. And from there, we don't usually have a negative value for cash, but this particular company I think they had an overdraft balance at the time, so that's why you see a negative balance. But typically, whatever cash balance they have on their balance sheet would be added, and any amounts due from related parties. So any amounts due from shareholders or whatnot, or associated entities or anything like that. And from there, we have the enterprise value. Again, that's the value of both the debt holders' claims as well as the equity holders' claims. So from there, we subtract the face value of debt right now as a valuation date. We subtract how much we owe to related parties, and there we have the value of the company's equity. That is the value to shareholders. Okay, and we typically like to do this in a range. Is everybody okay? Yeah.
Yes.
Okay.
Yes, sir.
Fantastic. And this is how we determine cost of capital. Now, for primary equity investors like venture capitalists, PE firms, and well, you guys, you may just decide, hey, what? I want to get a 25 to 35% return on my money. And you might just say, all right, my cost of equity would be in the range of 25 to 35%. Now barring that, if we're valuing the company for valuing the company's sake, we would start with a risk-free rate based on what's the government of the country, the country's sovereign debt. I'm trying not to be too jargony, I really am. But the the government of the country, or in the US case, you look at what is the 10, 20-year US Treasuries trading at. We look at the equity risk premium because we appreciate that debt has guaranteed cash flows built in. You know your interest rate, you know your amortization schedule, you have to pay it like that. So a debt investor has a lot less risk than an equity investor who's just hoping that the company proves to be valuable over time. So you have a premium, you have a risk premium for that to compensate investors for that. You have a size premium because all remaining unchanged. A larger, more established company is less risky, should be less risky than a smaller company who's just trying to figure it out. And then you have an industry risk premium because some industries are a lot more risky than others. And the CSRP is the company specific risk premium. That refers to business risk. Okay. And then you determine, okay, what is the market weighting of the mix between debt and equity? So you might look at publicly available information for companies in that particular industry and say, okay, this sector typically finances their company using 85% equity and 15% debt. So you may see like technology companies using higher equity ratios than, say, a company with a more capital intensive company. They may have more debt funding their business. So from there, you get your weighted average cost of capital, which is between your range of 18 point. Oh, yes, you have CAPM. So we use CAPM, Kevin, most of valuing publicly traded companies because then you have an observable beta or measure of systematic risk that you can use. Right. But for private companies, and this is also like my preference for private companies, especially here, it's to use this build-up method versus the CAPM. But you can implement the CAPM for privately held companies. Me personally, I just don't find it as accurate. But yes, folks do use CAPM for valuing privately held companies. Okay. And then we have the market approach. So this is what we use as a sanity check. After we've conducted our detailed discounted cash flow valuation, then we're going to look at the market approach to see, okay, did we yield multiples that seem to be in line with what the market's saying? Did I do this properly? So sort of thing, you know. So yeah, we look at market multiples to say where's the market at right now, and this market here is usually the market of publicly traded companies, right? So these companies are more liquid, they're typically bigger, you know. So you expect that their multiples should be higher than a small privately held company. And then if other multiples you can look at are multiples of companies that were bought and sold, so mergers and acquisitions. You know, we call that guideline transaction comparables. But the challenge with that is that those comparables would include those synergies that we spoke about, the extras that a McDonald's would pay for acquiring Burger King and all of that. So then it's to determine what was the amount of that synergy, what's the level of that synergy, so we can back that out and determine what is the real intrinsic or the fair market value of this particular company we're looking at. So this is a sanity check I did for that company I valued back in 2022. So you see that the market enterprise value to revenue multiple was around 2.9, and when I did my valuation, I was actually in line there, you know. So, and it was a stressful valuation to work on, so I was happy to see that it made sense. Okay. So I think that's it, guys. I think we were able to get through the valuation presentation in just under 50 minutes. And now I am happy to show you guys a few investment opportunities that's on my desk right now. But I will take questions. I will take a couple questions first.
So Kevin, I've got a question.
Sure.
So when we're looking at, I almost want to go to one of, let's go to, oh goodness. Felicia, let's go and let's go to WeFunder. And let's pull up per Vista.
Okay.
Oh, that's all right. Okay.
Doing slow here. Hold on.
And Kevin, it's okay if we go a little long tonight.
Oh,
This is-
okay, great. Okay, great.
This is helpful, so we won't rush you along.
Great.
I don't know about 2 hours, but maybe an hour and a half. Okay, so let's look at the valuation. So when we see future equity 5.4 million valuation cap, tell us what this means in association with what you just taught us.
Okay, 1 second. Let me just close this off.
Can you see my screen?
Right. So let's go. You said where's the valuation? 5.4 million valuation cap. Okay.
And actually it says 6 million is crossed out, right? So they so tell us, because I always look at this and I see that this as, oh, valuation was lowered, right? Which means this company is really valued at 6 million, but there's some kind of a discount being applied. So if I invest today, right, the thought is that in the future, the company is worth more and my investment will be realized in the rate of return, right? Is that the right way?
You're very much correct. So what they're saying is that they want to price the valuation around at a $6 million valuation. So let's say you are investing in the company. They want to treat your investment as though the company was valued at 6 million and give you your share ownership based on that, which would be less, right? But if they say, hey, we're going to give you a 10% discount and we're going to cap the valuation at 5.4 million, now you're getting a bigger percentage, possibly more shares in this, let's just say a bigger percentage, because share count is, so you're getting a bigger percentage of this company based on the valuation cap of your investment. So they may go ahead and do another round next year of 20 million, and then boom, sitting pretty nice.
Very good, very good. So I want to make that clear when we're looking at this, because we see this all the time. The other thing is, so when I see this valuation and I want to then go through the exercise you just took us through, the financials that the founders have on their campaign pages is what I would look at. So Talisha, if you could scroll down and let's see where Bernard's financials are.
Nope, that's the market stuff.
Yeah, that's the market stuff.
Yeah,
there's a form. Did he file his Form C?
I think not, because I think
scroll all the way down again.
This is all the way down.
Yeah, the Form C is filed, so it must be up some. Go into details. There you go. So here's the Form C, but there also may be some financials up. Scroll up before you go into the Form C.
So this is where it starts. I think this is the safe. This is the issued outstanding debt. Do you want something else?
So there are some numbers here. They tell use of funds. Let's go to the Form C and see what it says. I wanted to be able to tie in, right, how we can use the information Kevin just gave. Go into the first document.
Can everybody still see my screen?
Yep.
Yeah.
Sure.
Sometimes the Form C has detail in it with some financial. Sometimes there's a link.
Yeah, let's see, offerings. This is just the offering amount.
So the amount of shares. Okay, it gives, right in here, it gives some of their annual report disclosures.
Some balance sheet information. Assets, cash, receivables, debt. Okay. Okay, then it says revenue, sales most recent. Yeah, okay. Okay.
So that's
Nice.
kind of where we would be pulling. If they don't have like, the 3 or 5 year projection slides, this is kind of where we'll be getting some of those numbers from to do your exercise. Okay.
And
So I
this is
just wanted
why
to show that.
sorry. Now, just saying, this is why I always advise founders to prepare projections, because if if projections are provided and you say, okay, last year's revenue was 100,000, you as an investor, you're going to assume, okay, well, maybe next year you'll do 110. You know, if you have a good year, that's 10%. And maybe the year after that, you'll do 125. Meanwhile, the founder's thinking, well, next year I plan to hit 500, and then the year after that I plan to hit 3 million. But there's that mismatch, right? And you're going to value the business assuming, okay, well, it's going to grow steadily. And then eventually it's going to taper off to 2.75%. Right. So that is why because then you're leaving a lot of value on the table. And again, investors are going based on growth and risk. And if you don't provide investors with a reason to believe you're going to achieve aggressive forecasts, they're going to take it safe.
Very good point. And I do know Vinard shared that when he did his pitch. So for those of you who may be interested in Provista, go back and look at the actual presentation. But I wanted to show you, and I went to WeFunder as an example because that's one of the places we go to the most, but just know that how all this information ties in and where you can pull it from as you're doing some of your due diligence, excuse me. All right. So Kevin, tell us about some of the deal flow you have.
Sure.
There's also a question from Kevin in the chat.
Okay. But once you invest a certain dollar amount, your fraction of ownership should reflect your investment in proportion to all other investment amounts, not an arbitrary or subjective declaration of valuation, right? Well, Kevin, see what founders do is that but what founders do is that they will issue themselves shares upon founding the company, and they might issue, for example, 3 million shares at $1, right? And then when you come in, you're gonna pay $50 for that share, right? So that's how they do it, based on the amount of shares that are held, but not necessarily what dollar value is contributed. So there's a difference between the book value of equity and then what they say is the market value of equity, right? So book value of equity is how much actual cash is put in and how much you're holding on your balance sheet. Let me move this over. How much you're actually holding on your company's balance sheet. So that's the book value of equity. The market value of equity would be that 5.4, that 6 million that we think the company is worth, or that we're pricing our valuation around that. Yeah. Okay. I'm gonna show you guys a little bit of deal flow. Share screen.
Well, Kevin's pulling that up. I'll just share that this is kind of a bonus session. We will not have a Bet on Black pitch tomorrow because I am traveling and unavailable. So this is kind of a bonus for you guys to get access to some of Kevin's deal flow, since we won't have our own this week.
Okay. And you know what? Let me just share sound. I didn't know that we weren't having a Black pitch. Oh, that makes me sad. All right, let me just do it.
There's plenty more coming, Dally. Just hold on.
I just want to share sound because this particular one has a nice video. Why is my computer fighting with me tonight? Come on, we're live. Don't do that. Do I need permission from you guys to share sound or something?
No, you may have to go in when you go to share your screen. There's typically there is the button that says advanced at the top.
All right. Okay. Computer audio shares. Oh, but it's not letting me hit share sound.
If you go, so don't try to hit there's a different way Zoom requires you to do it now. Hold on. So when you
Okay.
go to share content or share screen, it's going to bring up, and my view is going to be different because I'm on an iPad tonight, but it'll bring up 3 tabs at the top. And I think one of them says advanced.
Yeah.
When you go to advanced, I think it's something that says share sound on computer.
Right. Okay.
And then, so once you click that and then go back to the screen you want to share, I think that will produce sound.
Okay. All right. Okay, so this is one company that I'm working with. This company is actually, so these are founded by 2 Trinidadians. The company is incorporated in Delaware. They completed Techstars in 2022. What they do is they help Shopify stores use augmented reality and artificial intelligence to insert visual ads for customers in a seamless manner, so it's not disruptive. So I'm just going to show you guys a sample. Okay.
So we didn't hear the sound, but we could see the visuals really nicely.
Okay.
So was it so when you say augmented reality, so all of the images were integrated into that Shopify store by this company?
Yes. It's cool, right?
It's almost as if it was, I mean, it was like it was commercials, right? I mean,
Yeah.
that was pretty cool.
Yeah. So they're doing a round to do it get to do their go-to-market strategy. They've already started generating revenue. So if anybody's interested in having a meeting with the gentleman, I'm just going to put my email address in the chat. It's Kevin at kevinvalue, there's that word again, .com. Okay. All right. So another company we have.
Talisha, we may want to pay attention to them just for our Shopify store that we're creating.
Oh yeah, for sure. So this other company, let me just share this one. So this company is it's a travel app that also is using augmented reality to enhance experience, especially for adventure seekers and people who like to roam, right? These guys are also raising to do the go-to-market strategy. So the genesis of this business is that they would used to have these treasure hunts across the island. And they'll get thousands and thousands of people doing it. It is so engaging. It would be like a big event. People drive from one end of the island to the other. I mean, probably a few hours, but it's still long for some of us, right? And they've generated a lot of traction from that, and now they've developed a technology, is almost getting ready to launch. They have developed this technology. It's starting off in Trinidad. It's going to expand into other islands in the region, and then they expect to be in other countries in the world by the next less than 2 years. Okay, so that's Roam Reality. You can let me know if you're interested in looking at that. Okay, so the third company, they are looking at addressing, this is a Caribbean company as well. They're looking at addressing the US $9.5 billion financing gap for small and medium-sized businesses, women-owned businesses, especially that are operating in the Caribbean. So you think about women-owned businesses in the Caribbean looking for cash flow solutions, financing. Doesn't always have to be debt and equity solution. Doesn't always have to be purchase of shares, but they need money to buy inventory. Or there's a timing difference between when they're able to provide this product or service, but they're waiting on supplier goods and all of that, right? So if anybody's interested in looking at that, they're looking for money to get the fund started and to hit the market as well. So that's Inspire Capital Solutions. All right. So then we have my friend here. So this is a gentleman. He's based in the United States. He's born and raised in the United States, but his parents are Caribbean, and he founded this sleep apnea treatment and diagnostic business in the region. He's been running it for well over 10 years. Revenues have been growing. It's been profitable each year, especially during the pandemic. He's written a book about sleep apnea, and he is the most energetic and passionate person you ever meet talking about sleep. Right? So we're doing a round for him to expand into other islands in the Caribbean region, and he's also looking at expanding in the United States. We have here. Well, these guys, this isn't loading, but this is a renewable energy and solar play that is operating out of Guyana right now and looking to expand to other territories in the Caribbean. So right now they're looking for a little bit of money just to hit their next milestone, 125K just to hit their next milestone. And then, they have their schedule of how they want to allocate their funding. So very disciplined in terms of when they want their funding, what they want to do with the funding, and so forth. And lastly, we have a restaurant outfit that actually has it's actually a franchise here in Trinidad. I don't want to say it's like Chipotle, but they do burritos, tacos, salad bowls. It's healthier style. It's not just on that Mexican sort of flavor, right? They're looking to either, because the gentleman, he's based in the US right now. COVID was rough on restaurant businesses here. So he's considering focusing on the US. So he's looking for funds to get the business into the US, or he's also open to an exit if it makes sense. All right. So that's what we have. Oh, how did I forget this one? So this is a Nigerian doctor.
Oh yeah, how did you forget this one? This was the one you showed me. I was really impressed with this one.
Right? How did I forget this one? So these Nigerian doctors based in New York. They developed this portable medical treatment innovation that he actually uses in his practice in New York. He's been using it for several years. He's been trying to get it to the Nigerian market, especially so that he could provide healthcare to all corners of the world, in rural areas, what have you. At least have that level of first response healthcare that also has a built-in computer and software to collect data that could be sent to doctors for be it telemedicine or remote medical treatments or whatnot. All right. So we're putting together their go-to-market strategy and everything there, but we developed this landing page for them. So you guys could check out this landing page, find out what are the different devices that's in the box, call it Hospital in a Box. What are the different features? Look at a couple of these testimonials here. And if you're interested in learning more, you could always join this list. Just submit your name and email and information. Or you can reach out to me at kevin@kevinvalue.com, as I put in the chat, or hit me up on LinkedIn. And I think we're good to go.
Good. Very good, Kevin. Thank you so much for that. And anytime any of these companies want to come and officially pitch the 10K project, we would be more than happy to have them. But this was great information. Thank you so much for helping us kind of uncover the mystery around valuations. And we really, really appreciate that. I think it's really going to help, especially when we combine this with next week's session where we talk about due diligence. And so, you know, ultimately we're trying to reinforce some of the early trainings we've done with how to do due diligence and how to determine if a business is right for you, right? Depending on whatever your criteria, individual criteria is. So we're just refreshing some of that training because we want to create smart investors always. And so this is a great complement to that. And I think it's going to help people really understand better what they're seeing, especially when they see projections and revenue that doesn't support some of the valuations that we sometimes see. Now we can kind of determine that, right? We can see when that doesn't make sense. So thank you very much for that. Talisha, anything in closing for you?
Oh, thank you again. And I do think this is very helpful to, you know, to look at certain things. Sometimes we think we know what we're doing, and I just think it's the reinforcement of seeing it over and over, and where some of the value can be extracted from just those little small things that we can do consistently to get us to where we're needing to go.
Yeah.
Fantastic.
Any final questions for Kevin this evening, guys?
I have a contact for you with regard to your sleep doctor. I have a sleep entrepreneur in my network, and I think she'd be a great connection for you too.
Awesome. Yeah, you love it. You love it. Listen, I've never seen somebody so passionate about sleep.
Yeah, she's amazing. She has a sleep practice. So she is, it's like amazing thing, but it's a big deal.
Thank you so much for your time and attention, everybody.
Thank you so much, sir. We appreciate you right back.
Thank you. Everybody have a great week, and we will see you next week.
We will see you next Monday, guys. Remember, no Bet on Black Pitch tomorrow. So we will see you all next Monday. Have a good week, everyone.
All right.
Bye-bye. Good night.